All right. Welcome, everyone, to Value Investing Live. I am pleased to present our guest, Jerome Dodson. He is the founder and chairman of Parnassus Investments and is the lead portfolio manager of the Parnassus Endeavor Fund. The second quarter ended with a portfolio valued at $919 million and a turnover rate of 52%. Several top holdings have estimated returns over 100% during their lifetime. As always, feel free to post your questions in the chat throughout the presentation, but keep in mind all questions will be held until the end once we jump into the Q&A. And in that case, I'll go ahead and hand things over to you, Jerry. We can go ahead and kick things off.
Thank you very much, Graham. And I want to thank everybody here who's watching us. Thank you very much. And during the next hour, I'll be covering my background, investment style, and some stocks that I've identified as good buys. Afterwards, I'll take your questions with Graham helping me out on the question side. The founding of Parnassus Investments started rather late in life for an entrepreneur with an idea when I was 40 in 1983. The following year, the company began life in the basement of my house in San Francisco with only one employee, me. Although it was a late start, I did have some valuable experience prior to the founding. College years were spent at the University of California at Berkeley, where I studied history and political science, before entering the Foreign Service of the State Department in 1966. My career took me to Washington, D.C., then to the American Embassy in Saigon, Vietnam, and finally for service as the American Consul in David, Panama. The time in the Foreign Service was extremely valuable for my development as a person, and I value it very, very highly. Nevertheless, it was not the right career for me, and my newfound interest in business led me to enroll at Harvard Business School. My first job out of business school was as a financial analyst for the nonprofit San Francisco Local Development Corporation, providing business and technical assistance to minority entrepreneurs. The job was interesting and worthwhile, but my career came to an end when the nonprofit lost its federal funding and had to cease operations. After that, I spent a couple of years doing business consulting. The first big break in my business career came in 1975 when one of my consulting clients asked me to write an economic study and prepare an application to start a new bank in San Francisco. The application was successful, and I was pleasantly surprised when the group hired me as the chief executive of the new institution. We started operations in 1976, and at age 33, I was a bank president. I served there for 7 years until 1983, when I left to start a new mutual fund company, Parnassus Investments. There were two central ideas in the founding of the company. The first was the investment philosophy of Benjamin Graham, whose bargain hunting philosophy appealed to me. He only invested in stocks that had dropped to very low levels, and I was born into a family of modest economic means. So bargain hunting was second nature to me. Also, it hadn't escaped my notice that Graham's most famous disciple was Warren Buffett, an extraordinarily successful investor. The other idea was social and environmental responsibility. Even before my days at Berkeley, I had developed a social conscience, so the idea appealed to me. The term ESG, environmental, social, and governance, didn't exist back then, so we were plowing new territory. Back then, we just called it social investing, or maybe social and environmental investing. Intuitively, I thought that what is now called ESG made economic sense. If a company was environmentally responsible, it was less likely to be fined by the government or sued for damages. If a firm used less water or less raw materials, that should help to reduce costs and allow more money to drop to the bottom line. Similarly, if a company treated its employees well, they would work harder and be more productive. Also, such a firm would be more likely to attract the best employees. Prior to starting the fund, I worked with journalist Milton Moskowitz, who wrote a book on great places to work. At the time, we found that companies with good workplaces had better investment returns than the S&P 500. Charitable contributions and community involvement were also important issues for Parnassus. Although these issues would not have a direct impact on the bottom line, my thought was that companies with these characteristics would have more progressive management and be able to do well as businesses. When I started the business in 1984, my calculation was that the Parnassus Fund would have to have $30 million in assets to break even. A management fee of 1% would yield revenue of $300,000 per year, which would be enough to pay for my office expenses, my living expenses, and the salaries of 2 staff members. With about $150,000 in savings, I calculated that I had enough money to subsidize fund operations for at least 3 years before running out of money. Since I was married and had 4 children, there was a lot of pressure on me to perform. It was a race against time to see if the fund could grow to $30 million in assets before the savings ran out. As it turned out, assets did not hit 30, but did not even reach 20 million. By June of 1990, the fund had $26 million, so I was hopeful that assets would grow to 30 million by the end of the year. Unfortunately, that did not happen. Saddam Hussein, at the time the dictator of Iraq, invaded Kuwait, precipitating the Gulf War, and the stock market crashed. Fund assets dropped below 20 million by September of 1990, and there was very little left in my savings account at the end of the year. There was no alternative but to close down the business. My future looked very cloudy. I had no idea what I would do. At age 28, when I had just graduated from Harvard Business School, there were a lot of firms that wanted to hire me, but job opportunities were limited for a 47-year-old failure. Since I had no idea what I would do with my life, 1991 began with a lot of thought and a lot of introspection. The future looked very cloudy, and there was no clear path forward. Before making a decision on my search for a job, something strange happened. I don't know if any of you watching this program believe in miracles, but I do. Before the search for a job got underway, something strange happened. The stock market started to recover. By the end of the year, the S&P 500 was up 36%. Even more remarkable, the Parnassus Fund gained 52% that year, hitting the charts as the best performing growth fund in the country. Assets climbed well above 30 million by the end of 1991 and reached 100 million around the end of 1992. Parnassus Investments became a viable business, and I never looked back. As it turned out, the stocks in the portfolio were carefully chosen, but it took a long time for the value to be recognized. We now have over 30 billion, that's billion with a B, in assets in 5 different mutual funds. The combination of good investment performance and the social responsibility focus had combined to grow the firm to a size I never thought possible. Parnassus has a great staff, so people are the key to our success. The most important factor in building our great staff has been our intern program. Ironically, I was reluctant to start the program. It was 1986, and I had just moved Parnassus from the basement of my house into an office in San Francisco. It was in the financial district. A friend of mine had referred a young woman who had attended Evergreen State College in Washington State. One requirement of her curriculum was finding an internship. When she called me up, I told her that I didn't have the time to supervise an intern, but she was very persistent and I couldn't get her off the phone. As it turned out, she did a great job and saved me a lot of time. After that successful project, I decided to make the intern program permanent. A lot of the interns I hired came from the two schools I attended, Harvard and Berkeley, but we also recruited them from other colleges as well. As it turned out, all of our research staff and portfolio managers came from the intern program. That gives us an enormous advantage since we're able to see candidates up close before we hire them. Both my successor as president of the firm, Ben Allen, and our chief investment officer, Todd Olson, came through our intern program. Now, let's talk about the Endeavor Fund and how I pick investments. The Parnassus Endeavor Fund is a large cap stock fund benchmarked to the S&P 500. I've been running the fund since inception in 2005. Billy Kwan joined the team in 2018. The fund represents Parnassus's clearest expression of ESG as it invests in companies with outstanding workplaces. The fund follows a contrarian investment style, meaning I buy out of favor companies that are trading at about 1/3 off their intrinsic value. The first step I take in picking investments is to calculate the intrinsic value of a stock. There's no way of knowing what the exact value is, but I try to make an estimate. Once I calculate that number, I knock off 1/3, and that is the price I'm willing to pay. If I think a stock is worth $100, I won't pay more than $66 a share. That gives me a margin of safety. If my assessment is correct, that means the stock should appreciate about 50% when it reaches its intrinsic value, from $66 to $100. Of course, there's no guarantee that my calculation is correct, and some stocks will never hit that target. On the other hand, some stocks go up even more. During our average 3-year holding period, the intrinsic value of a stock can increase, so we will hold that position beyond the original target price. Calculating intrinsic value is not an exact science, but it's a very useful exercise. By investing when the stock is selling at 2/3 of its estimated value or less, we leave ourselves a margin of safety. Here are 4 ratios that I think are useful in valuing a stock. First is price to book. Second, price to earnings, or the PE ratio. Third, price to sales ratio, PSR. And fourth, price to 5-year high. There are no absolute numbers to use since each industry is different, and even each company in that industry is different. What I do is compare each ratio against the high, low, and average ratios for that company over the last 5 years. The ratios at that time are below the averages. It's a candidate for investment, and it makes sense to do further research. There are also some balance sheet ratios that I consider. When I look at a balance sheet, I'm trying to determine if a company has enough financial strength to bounce back from whatever caused the stock price to go down in the first place. So why would it drop for less than 2/3 of its intrinsic value? Now, here are some of the ratios that I use. The current ratio is just current assets divided by current liabilities. Usually, I like this ratio to be 2-to-1, so the current assets are double current liabilities. This provides the financial strength to move the stock price higher. In many cases, though, you don't need a 2-to-1 ratio. For example, airlines never have a 2-to-1 ratio since they have hardly any receivables. Customers pay for their tickets in advance, So airlines can use the customer's money for working capital. An investor needs to use a lot of common sense to decide what the appropriate current ratio should be. The important point is that there should be enough current assets to carry the company through difficult times. And of course, when you're doing your analysis, you're going to find out that each company in a different industry is going to have different characteristics, and you have to use common sense with that. Now, the quick ratio is cash and accounts receivable divided by current liabilities. This ratio does not include inventory and prepaid expenses, so it only includes items that can be quickly turned into cash. In general, I like a ratio of 1 to 1. If there's a good reason, it can go below that ratio. Next is the long-term debt to equity ratio should ideally be at 0.7 or less. So long-term debt would be only 70% of net worth. However, if the other financial dynamics of the business are strong, the ratio could go to 100%. The investor should be certain that the company is not burdened by too much long-term debt. That's the general idea. Of course, an investor can always look at other ratios as well, but these are the most important ones for me. Besides these quantitative factors, there are also some qualitative factors that are important to consider. Here are 4 of the most important ones. Number 1, moat. I learned about this one from famed investor Warren Buffett many years ago. He used the term to describe the body of water around a castle in ancient times that made it difficult for enemies to attack the castle. Buffett described a moat as an unfair advantage that a company has to keep competitors away from its territory. A moat can mean many things, but examples are a low-cost advantage, a strong sales force, a well-known brand, a superior product, or a high cost of entry into a market. You've also noticed that Morningstar now uses the moat as well. They've refined it more, and so if you're an investor looking for an idea on the moat or another assessment on the moat, Morningstar would be a good place to look. But again, the original one is from Warren Buffett. He coined the term the moat to describe this. Number 2, marketing oriented. Virtually all successful companies are marketing oriented. They have a special way of selling their product or service, and they are always looking for ways to improve their marketing strategy. So again, how does the salesmanship work into the equation? Those are the things that you want to look for. Say, hey, there's got to be some way to market to sell this product. Number 3, quality products or services. There are many products or services out there in the marketplace, but the most successful ones have a quality product or service. This means the average consumer recognizes the product or service as being among the best in its category. So again, very important. Not only be marketing oriented, but a quality product. Number 4 that I'd like to talk about is the margin of safety. The margin of safety concept comes from Warren Buffett's teacher, Benjamin Graham, who taught at Columbia Business School while he ran his investment business. He was conservative in many ways and would buy only stocks that were selling at a fraction of their intrinsic value. In fact, he even found companies where the stock was trading at less than the value of the company's working capital. It's almost impossible to find stocks like that now. But the concept is a good one, since if you buy a stock at a very low price, it's unlikely to go down much more. The lesson here is that you don't buy a stock after it's had a big run-up. Wait until the price has dropped. The market is at a very high level right now. So there are very few stocks that meet the value criteria. Most stocks are overvalued right now. but I would like to recommend two that meet our criteria. These will serve as an interesting illustration. Please remember that any stock that meets our value criteria will not look good to the average investor. Why not? Because something has happened to knock down that price. I'm nervous anytime I started a new position in the stock, since most people think it's not a good investment. Being out of favor with most investors is what makes a stock sell at a low price, and it's what creates opportunities for the enterprising investor. The first one I'd like to talk about is Herman Miller. Herman Miller is a furniture company based in Michigan that makes high-quality office products, including the famous Aeron chair. Because of that quality, there's normally a very high demand for its chairs. With Americans working from home during the pandemic, companies are not buying much office furniture, so the stock is in a deep slump. It trades around $24 a share, down from a 52-week high of $50. So you're getting 50% off its high water mark. It's taken strong steps to reduce emissions and purchases renewable energy credits to cover 100% of its electricity use, and even measures the emissions of its suppliers. So it's a very sound company from an environmental standpoint. Those of you that like to take environmental factors in making your investment decisions. Its workplace culture emphasizes employee input and collaboration, and 16% of the company's shares are held by employees. Let me say that again. 16%, that's 1/6 of the company's shares are held by employees. You don't find that very often, but I like the idea that employees have a major position in the company. It gives them a special incentive. Now, Miller's median pay surpasses peers, and safety and diversity performance are strong. I have personally visited Herman Miller in Michigan, and it's a great company, great people, and really an interesting experience visiting that firm. Here are the ratios. First of all, the price-earnings ratio is not going to help us. Why not? It's not meaningful, since Miller is not making any money. So if you don't have any earnings, you can't get a PE ratio. But I can look at the other ratios. Price to book is 2.17 compared to about 3.8 over the last 5 years. So you can see on a price to book ratio, it's selling well below the average of that 3.8 to 2.7. So that's a good value indicator. The price to sales ratio is 0.56. That compares to 0.88 for the last 5 years. So again, it meets that criterion because it's selling below its price to sales ratio over the last few years. Finally, price to 5-year high is only 0.48. So it means it's only selling at 48% of what it was selling for sometime during the last 5 years. Return on equity is not meaningful for the reasons I already outlined because of the loss, but it's been about 23% for the previous 5 years. So 23% return on equity is pretty good. Usually, I like it to be at least 15% return on equity, although at times I've gone below that if it looks like it's going in. But if it's consistently below that, let's say it's 7, 8, 9% return on equity, it's not a very good business. So the current ratio is 1.79, so that's close to our 2.0 guideline. The quick ratio is 1.25, so that's actually more. Long-term debt is $847 million versus a net worth of $693 million. So the long-term debt's a bit over our guideline, but it's not way out of line. Now, as many of you may know, Herman Miller is suffering right now, but the stock price reflects that. So it's trading at bargain levels. If things improve, the stock should climb much higher. Again, there's uncertainty about when that improve will come, when the coronavirus will be over. So, we don't know for sure, but we do know that it's selling at a good value. And if those factors change, Herman Miller should snap back. The next one I'd like to talk about is Charles Schwab, which I think most of us know. Schwab is much more than a discount broker. In fact, only around 15% of its earnings come from commissions. Technically, it doesn't charge commissions anymore since it took the lead in abolishing commissions. It makes money off the spread between the bid and the ask on securities trades. So that's where, but only about 15% comes from that. It's more like a bank, since most of its earnings come from the interest it earns off the spread between what it pays clients and what it earns in interest. So again, you have to look at Schwab like a bank or general financial institution, even though its history is from a discount broker, and we think of it as being a discount broker, but really the nature of the business is very different. Now, Schwab's core business, though, has made investing more affordable and more accessible. The company's competitive advantage is its convenience, supplying advice to its customers, and the provision of a range of services. So it's really changed the brokerage industry. It provides a good place to work, and it's improving its own ESG efforts and disclosure. The company is recognized for diversity and inclusion and has an annual engagement survey and offers employees educational and development programs. So it's a good place to work. Schwab's stock price is down, primarily because it doesn't earn much interest on its deposits. If interest rates increase, Schwab's stock should move much higher. Current price is around $35. The 52-week high is 51. The 52-week low is 28. So you can see it's closer to its low of 52-week than to the high. So it really is trading in a bargain price. Of course, the reasons why it's trading at the bargain price, but if those reasons change, mostly interest rates, then Schwab's going to do very well. Since Schwab is a financial institution, the balance sheet ratios are not meaningful, but here are the price ratios. Price to earnings is 14.5. That compares to 25 for the past 5 years, so that's way below. So it hits our bargain point. Price to book is 1.81 compared to 3.5 for the past 5 years, so well below its 5-year average. Price to book. Price to sales, 4.17 compared to almost 6 for the past 6 years. So again, it's below its averages, so its bargain indicator is good there in price to sales. Return on equity, 16%. Again, that's pretty good. As I say, 15% is what I'm looking for. However, if the interest rates come back, Schwab should do much better. Now, both Schwab and Herman Miller present interesting opportunities right now, and they are good examples of the kind of stocks that the Parnassus Endeavor Fund might buy. They also illustrate the kind of analysis that I do on stocks. With that, I'll be happy to answer any questions you might have.
Alrighty, everyone. So once again, thank you, Jerry, for the wonderful presentation and giving us a nice overview of how you go about things. We'll go ahead and open things up to questions here. Feel free to post them all in the chat, and we can go ahead and I'll be sending them over to Jerry here so that he can give you answers. We do have a couple already in the queue waiting for you, Jerry. So first up, we have a question. How much do you take for your margin of safety, and what is your discount rate when looking at companies?
That's a good question. The discount rate that I look at is usually around 15%. However, in other words, when I say the discount rate, it depends on how you define it. But what I'm saying by that is the return on average. In terms of the standard discount rate, of course, if you're basing it off of interest rates, then it's very low. Right now, it's tough to use that because the interest rates are so low that it's not meaningful. So rather than using a special discount rate, I look to say, can they get return on equity of 15%? So that's a little unusual. In normal times, you have your discount rate, the value would be lower than that. But again, say in the 7-8% range. But again, the 15% is what I'm looking for in terms of that's a more meaningful measure to me.
And when looking at the fact that many good companies are rarely cheap, how do you approach these companies that might not necessarily be at that cheapest price point?
Let's see. I'm not sure I understand the question. Would you ask it again, please, Graham?
Definitely. So we spoke a lot during the presentation about how you look for good companies, especially with those ESG factors. These companies are rarely cheap in today's market. How do you face that fact?
Well, that's really a difficult one. It's a good question. Is that you're not finding. And when I was trying to get examples for today's talk, the only two I could come up with that are ready to buy that were low are the Schwab and Herman Miller. And so most of the portfolio now is companies that I purchased before and that are going higher. But sometimes you may want to keep some money on the sideline and wait for the market to correct itself. Right now, the market's trading at a PE ratio of 26. That's very high. Normally the range is 15 to 18. What that means, there's not many bargains around. Now, there were some great bargains along about the end of March into April, even into May. Much to my surprise, the market shot up for almost no reason. And so now you have all these stocks trading at very high rates. It did a complete U-turn, much to my surprise. So instinctively, I think we're living in a fool's paradise, which means that if you start buying this coming into the market now, I think you may regret it because I think we're due for another move down. But you never know. I'm surprised it came up. So I think I have the ability to evaluate an individual company. But in terms of saying, where's the market going? I don't think I have any ability. It does things that never ceases to amaze me. So for right now, you can look at a couple of companies, say like the Schwab I mentioned, Herman Miller. There'll be a few others out there trading at prices. But if you're a value investor, there's not much out there. And so, you're in a difficult situation. So my only advice to those people was, hey, put some money aside, keep it on the side, and when the market goes down, come in.
Definitely. And do you do DCF modeling for all the investment that you do?
I used to do a lot of it, but what I found was that the discount rate you used and the terminal value had so much influence on the price. And so it's not, and it's interesting to do, to go through and look and see, but it changes so much, by those two factors. So usually I use the more simple ones that I just outlined in my talk. I found them much more useful. From an intellectual standpoint or an academic standpoint, a discounted cash flow makes sense because in the final analysis, that is the worth of a company. It's discounting the cash flows over time and the terminal value. So intellectually, it's correct, but decided to use it on a practical basis, it's tough. So you get just too many strange things depending upon what your discount rate is, what your terminal value is. So it's just not as productive. It takes a lot of time to do it well. So it's not as productive for me. So it's not one of the main things I use. I use the ones that I described more often.
Gotcha. So you'd rather keep a little bit more of a simplistic approach to it rather than trying to truly calculate that end goal of a company.
I'm a simple-minded guy, so that's the truth of the matter.
Gotcha. And do you have a guideline on return on assets?
That's a good question. It's hard for me to say a return on assets. The reason being, it depends a lot on how much net worth it has and the other ones in there. So I kind of look at that. In fact, you can find that on the Hilbert machine. We talked about that, and I think you can find it on Yahoo too. I'm not sure, but I think you can. So really what I try to do is I look at historically what the return on assets have been, and if it's say earning more than that, then it would be a candidate. So I do use it on a comparative basis, but not all the time.
I see. And within a portfolio, how do you approach position sizing?
Well, for a mutual fund, you've got some fairly clear guidelines. At the time of purchase, with regard to 80% of your portfolio, you have to have no more than 5%. So when you first buy a stock, you can only put 5% in there. So if you have the whole portfolio, you're just doing the arithmetic. You talk about 20 positions at 5% each. Of course, the world doesn't work like that. The world is very messy. You've got your ups and downs and you go around. But in generally, I think the 5% is a good. It's a good standard. Let me just put it that way. However, sometimes, every once in a while, I'll go above that. I can remember a company called Altera, which doesn't exist anymore. It makes semiconductors, and it was in the process of being bought out by Intel. And there was a huge discrepancy between, and these numbers are going to be estimates because I don't remember exactly what they were, but it was something like maybe if Altera was selling for like maybe $35, it was about $45 was the price that Intel would pay. And there was a lot of uncertainty whether the deal would go through, and that's why it was selling for a low price. I think I put up about maybe 12, 14% of portfolio into Altera and did very well. There was some risk, but I thought the risk was minor because Intel was motivated to get into the type of business to making the kind of semiconductors that Altera was. Occasionally would do that, but it doesn't happen very often. Usually I think 5% of a portfolio in any one issuer is really the right number.
Gotcha. And do you have any opinion on any of the big automotive producers, such as Ford, anything like that?
No, I don't follow that industry too much. I have seen what Tesla's done, though, much to my surprise. I think it's tripled since I thought it was fully valued. So that shows you what I know about the automotive industry. So, and the question is, are we all going to be buying Teslas in a few years from now? What's interesting is that their competitors, GM makes a car like that too that runs off of batteries, and I think as well as the other companies. But for some reason, their market share is very, very small. I think Tesla has something like 80% of the electric cars are Tesla, which is huge. So there's something they're doing right. I mean, people like that. If being environmentally conscious is a good idea. If you're an environmentalist, it makes sense why a company like Tesla has no emissions. It's very good for the environment. The issue, of course, is when you're driving along the freeway and then you're almost running out of juice, you got to get over, and how long do you have to stay charging up your car? Probably an hour at least. So the difficulty is, can you use it for long distance travel, cross country? I mean, you can, but there's some drawbacks. If you're in the city and driving around and you can charge up the car in your garage or your driveway every night, it makes sense to have the Tesla, I would think, it's a city. But until they get something like, let's say 400 miles to a charge, once they hit that benchmark, then I think it'll be even practical for long distance driving.
Definitely. And do you have a normal holding period for companies, or one specifically for when you're in a good company?
My average holding period, I like it to be 3 years. So in other words, you'd have 30% of your portfolio turning over every year, or actually 33%. That always doesn't happen. Sometimes in these situations will turnover rates higher, sometimes lower, but as a rule of thumb, I think really a longer holding period makes sense. The dilemma comes when the company hits its target price. And then it hits the target price, and it's only a year or a year and a half. So what do? Do you sell, or do you continue to hold on? And I wouldn't be, put in handcuffs by that 3 year. But I think what you should do, if it hits your target price in a year and a half, I would look at it. I would reevaluate the target price. Hey, maybe it's gone up in value, maybe it hasn't. Do your own analysis, or do use the analysis that I've demonstrated here, and find out if the target price has increased. If the intrinsic value is higher, then hang on. But if you think it's reached the intrinsic value, even if it's only held it for a year and a half, sell. That's my opinion.
Gotcha. And in context of the current expensive market, what are your thoughts buying a stock high versus buying low in a dip in order to reduce the cost basis?
Let me understand the question. Does that mean you've already bought a stock at a high price and it's come down? Should you try to average down by buying it lower? Is that the question, or am I misunderstanding?
I believe the question's looking more at, due to the fact that we're in such an expensive market currently, if you can find those cheaper prices, are you jumping on them, or are you still sticking with kind of your guns for the most part?
No, if they're down there, I add. But again, I use the same issue. I try to say, what is the intrinsic value? And the stock has to be, 1/3 below. 1 in 10 of the question may be, if you don't find something like that, but you like the company, what do? And I think sometimes when that happens to me, I think what I'll do is I'll do what I call a watch position. A watch position would be a size of no more than 0.5% of your portfolio. So you definitely wouldn't go to the 5% we talked about earlier on. But I would put that in there, and then you could watch it. What this does, it has you do your research. You know where your purchase price is going to be, and even though you paid more for it, then if it does come down, then you are ready to go and you can increase your position. So I think in that situation, I would probably go ahead and buy it a little more expensive than I normally would.
I see. And outside of those specific factors that we've gone over in depth when considering buying a company, or for selling in that matter, do you have a specific checklist that all the boxes have to be ticked to buy or sell?
The checklist I gave you earlier on, I told you what I'm looking for. And of course, I gave you a couple examples, like I was looking for a company that would be 70% of its value, book value. And quite often that won't work, and also some of the other ratios won't. So a lot of it has to be judgment. So these are really just guidelines. They'll vary from company to company, from industry to industry. But in general, once you develop those guidelines, sometimes if there's a good reason, you know why you're doing something, then it makes sense to go ahead and buy, even though it doesn't meet those exact numbers, because you got to get a feeling. So in that sense, it's more of an art than a science. I've given you some ratios here, given you some ideas. and it presented it somewhat like a science. And of course, in the real world, it's not. But these guidelines are helpful because it gives you something to go on, something to think about. And that if you decide not to follow this, or if it's not really in this one range, go ahead. But I think you just should convince yourself why it's a good idea. You should actually even write down, this is why I'm doing this, even though the book value is higher than it should be.
Gotcha. And it looks like we have a couple questions regarding, do you have any daily reads or specific books or anything like that you lean on to gain information or inspire your thought process?
You know, there have been a number of books that have come in. I think I would definitely read Benjamin Graham's initial book on stocks. And I think that a lot of it, as I say, is out of date. But at least it gives you a good idea. Then there have been a number of ones, I think, Common Stocks and Uncommon Profits. I think that one I found is useful. And there's a number of them out there. Unfortunately, I should have brought a list with you. I know this question, but I think anybody that goes through from a common sense standpoint, and they tend to be more value oriented, I think those are really good. So there's a lot of them out there, and unfortunately, they don't come to mind right now.
Definitely. Well, at a later date, we might be able to get that list from you and go ahead and give it to our audience as well.
Right, good.
And within a company, are there any operational capabilities that lend themselves to creating a good moat, in your opinion?
Yes, I think they are. Let me take off on the ones that I talked earlier. I'm going to use my notes and talk about some of our ideas and sort of see where we go from there. Like I gave you some in here, and I'm going to reiterate those, and then I'm going to go from there to continue on. Okay, so the examples I gave that I think are remote, it can be many things, but examples, if you have a low cost advantage, for some reason, say your power source is going to have low and you lose a lot of electricity in the process. One I was thinking about is a company called Micron Technology. They make semiconductors, primarily memory chips, and they're in Idaho. Now, Idaho, for those of you who haven't been there, they have a lot of water. They have a lot of running streams. So there's a lot of hydroelectric produced, so they can have a low cost, which helps them to compete with the foreign producers of those memory chips. So that would be an example of it could be a moat. So the low cost would come in there. Also, a strong sales force. And again, it's hard to get the right kind of sales force in. It takes a lot of training. You have to motivate them. But a strong sales force would definitely be a moat. A well-known brand would be a very good thing. Like right now, retail is having some difficult times because of all this we're having around the coronavirus. So, but there's a couple of companies that are for sale. I think Brooks Brothers is one. And of course, they've had difficulty selling men's suits. People aren't buying suits, but it's got a great name. And it's being bought not for the economic value of it, but for name of it. So yeah, a name or a brand, very important. And of course, the quality of the product that you have is going to be very good. And then also high cost of entry. We talked about the semiconductors earlier. So not only does Micron Technology have the advantage of cheap electric power or hydroelectric power, what they also have is a tremendous, cost advantage from the power, but also when they come in, it's very expensive starting a new plant. All that equipment you have to buy to make semiconductors, we're talking about tens of millions of dollars, maybe 50, 60 million. And so for a competitor to come in and do that, to learn the technique to get in, it's very difficult to compete. So that would be another example of a moat that's come in. So those are the ones that come to mind, but I'm sure that there in your audience, you have people that have very fertile brains, and you can come up with ideas. But if you're thinking along, what is the moat here? To ask that question when you analyze a company, it's a very good idea.
For sure. And are there any specific sectors that you see having big growth in the next 5 years for any particular reason?
Well, it's hard to know what's going to be happening. The ones that have really had, Amazon, I'm amazed at the growth that they've had. And, if someone told me, hey, here's a bookseller, they're going to sell books, over the internet, they're not going to have a store, I would say, hey, it's a crazy idea. But they did it, wiping out bookstores, which is not a good social purpose because your corner bookstore gets wiped out because people can buy it cheaper on Amazon. And then they started moving away from selling books, and now they sell virtually everything. So in some sense, they really are the evil empire. They've got, they're good at it, low cost. I don't like them from a social standpoint, but boy, just from a business standpoint, moving to the area, cutting costs, and people like them because it's very easy. You can just go online and order it, and it ends up being in your mailbox the next day or two. So it's, they really have they got a good business technique down. So that would be a good example.
For sure. And is there any particular person, whether it be someone more on a theoretical side or directly involved in investing, that has truly inspired you as a person?
I would say that the ones I mentioned, which is Warren Buffett and Benjamin Graham, have inspired me. I think those are really the names I've already mentioned. But there's a lot of others around, but those are the only two that I would say right now.
For sure. And all right, so we have a question asking, how do you handle the negative news and some of the panic sell-offs we've seen for the holdings in your portfolio? Do you consider those, or do you try and ignore them for the most part?
Do I ignore the panic selling recommendations? Yes. To be a good investor, you don't have to be the most brilliant person in the world, but you do have to have the right temperament so that when stocks go down, you can't get all concerned. You can't, as they say, freak out. You have to maintain your equilibrium. And only a certain type of personality can do this. Most people get very nervous when the stock they buy, say, even though they bought it at a good price, if it goes down by 10%, it's very nerve-wracking. Even for me, I've been doing this for 36 years. And when a stock I buy goes down, I feel the same way. I feel bad. But you have to overcome those feelings. In fact, my recommendation would be to buy more if it goes down. Of course, you have to look and do your analysis again. Look at the marketing, look at the finances, look at everything. But if you think that you're right, and intellectually you can go through with it, if the stock goes down, buy more, don't sell.
For sure. And as we're running up pretty much against the end of our time limit here, we'll go ahead and get one more question in here. How would you say that you personally calculate the intrinsic value of a company?
Pretty much the way I described it. What I try to do is I try to look at certain ratios. And let me just go over some of those again. That what I look at, I try to say, okay, what ratios were they trading over the period of time? And the ones I talked about are the ones I use for the first crack at it. I look at price to book, look at price to earnings, price to sales, and price to the 5-year high. And then also I look at some of those balance sheet ratios that I was looking at. So really, I try to look at all of them. And then when I find out the value, I say, okay, what kind of a PE ratio does it normally sell at? So that's one indication. If you take the earnings, the PE ratio it normally sells at, that's one valuation measure. And the same thing with price to earnings, price to sales. So again, and then also, for those of you who have access to Bloomberg, go through and look at all those ratios. They got about 15 in there. And say, okay, how is it sold? Over what period of time where's it been selling? And of course, the other thing is that I think you can even do this now on Yahoo, which is much cheaper than Bloomberg. In fact, I think they're early to start off. It's free on Yahoo, and then there's a modest charge to go to their premium. So I think using those services, if you're a cheapskate and don't want to spend $20,000 a year for your Bloomberg terminal, go for Yahoo. It's amazing the analytical tools they have.
Definitely. All right. Well, that is going to round out the amount of time we have for today. Thank you so much for joining us here, Jerry. It's been an absolute pleasure having you on. It was a wonderful presentation, and I'm sure our audience has learned a great deal from you.
Great. Well, thank you, Graham. Thank you for inviting me. I'm honored to be on, and I've heard a lot about the GuruFocus. This is the first time I've been on the program, so it's really interesting to me. So it's my pleasure, and I hope that I've been able to enlighten some of your viewers. It's some interesting techniques for investing.
Absolutely. And for those viewers out there, just so you know, this whole presentation has been recorded. It will be airing on our YouTube channel, as well as the full recap will be available on GuruFocus.com, and we'll be working with Jerry and his team to get a copy out over there as well. So thank you everybody for joining us. It's been an absolute pleasure, Jerry, and we wish you all good health as you keep going and keep living out there in this world that we're dealing with.
Thank you very much. Bye now.